Welcome to another episode of Inside the Investor's Mind, hosted by Jack Cohen, where we dive deep into the strategies, insights, and perspectives that shape today's leading investors. In this episode, we're joined by Dr. Joe Castillo, CEO of AutoFinMed Ventures, a global private equity and venture capital platform operating across more than 160 countries. His leadership spans biopharma, energy infrastructure, and global real estate development, industries driving some of the most significant transformations in the world today. Together with Jack, Dr. Joe explores how strategic financial architecture and visionary capital deployment can shape the future of global innovation and growth.
Welcome to the iCFO Capital Global October 25 Virtual Expo and our Inside the Investor Mind session. And this month's edition of Inside the Investor's Mind, where we invite a seasoned investor to share their knowledge and experience with entrepreneurs. My name is Jack Cohen, and I'm a partner here at iCFO Capital Global in La Jolla. And I'm your host and moderator today. And today's session is produced by our excellent marketing team, led by Alejandro Rosas. And a big thank you, Alejandro, to you and your team. Always do a great job, and we greatly appreciate your efforts. For our clients and those who are thinking about becoming clients at iCFO Capital, you gain a dedicated partner committed to helping your early stage company succeed. We combine our expertise in finance, capital markets, and investor relations to provide you with comprehensive support throughout the funding process. Our goal is to increase your chances of securing the capital that you need to fuel the growth and achieve your business objectives. And now a little bit about today's session. Each of our sessions are non-scripted. They're non-rehearsed, although we do have an interview with our guests just to kind of explain the format. And these conversations are designed to be ad hoc, similar to sitting over a cup of coffee at a Starbucks. So it's conversational in nature. And our guests have not been given a specific list of questions beforehand. And the purpose here is to do a deep dive into questions as they come up and as they develop. As a reminder, today's discussion is for informational and educational purposes only, and each entrepreneur should do their own discovery and their own due diligence when working with investors, just the way investors do their due diligence working with you. So today we are pleased to have Dr. Joe Castillo. Dr. Joe's skill set and focus is in private equity, biopharmaceutical areas, innovation, new therapeutics, drugs, medical devices, commercialization, nearshoring, and portfolio hedge management. He is the CEO of Portco and also does some CEO coaching as well. And I can spend the next 40 minutes talking about Joe's experience. It's long. It's longer than a rap sheet, a good one, and Joe's experience. But I'm sure we'd rather hear more about Dr. Joe's insights than me reading his excellent credentials. Let's welcome, all the way from Guadalajara, Mexico, Dr. Joe Castillo. Welcome, Joe.
Yes, my pleasure, Jack. Thanks for inviting me here within your organizations. It's a pleasure, to interact with some, I think, entrepreneurs. I noticed their name. Some of them are yet to meet. They're on the list, I guess, on the lineup. And, back to you, Jack.
Okay, so we had a little brief discussion yesterday. I talked with you about the format of the show, and your background is a little bit different from the typical investor that we invite onto our broadcast here. You do more of a consultative role with a good insight into the CEO mindset. And one of the topics that you mentioned was the psychology of CEOs. And some of the mindset changes that they have and some of the mindset changes that they might need to go through as they develop their business and go from one stage to the next. And so just as a starting question, from your perspective, what do you think makes or breaks a CEO from startup to exit?
I would say their desire and drive align with their ego. Because there's got to be a reason why they want to be an entrepreneur or something, right?
Sure.
Um, besides, making bukus of money, right? So there's got to be a drive there that you wanted experience, in the past, right? Um, and that is individualized, right? When we see that that doesn't line up, it's like, what is, you know, why are you doing this, right? You have to have that aligned as you go in there with your elevator pitch, your pitch deck, etc. But I think, having those aligned, your why. And how do you figure out your why, Jack? I think it's very simple. The founder or the entrepreneur needs to look themselves in the mirror and say, what do I feel like doing the rest of my life, right? How do I feel about this, right? Do I imagine myself, doing this today, tomorrow, and for long term, at least up until their exit point, right? So I know founders come that they're the jacks of all trades, right? But the thing
Some of
is
them.
they need to, yeah, they got to focus on one, right? Um,
You-
so
You've you've seen the Simon Sinek TED Talk on, it begins with the why. And
right.
I think and that's a very, that's a very well known TED Talk, and a lot of, a lot of people who go into business, look at that and kind of get some motivation about that. Um, Having a good why and knowing why your business is really key. What do you see, or how do you see the CEO's mindset evolving over time from early stage to, funding to maturation and maybe to exit? Maybe you can comment on that a little bit.
Yeah, I think what I've observed in practice here is that founders, entrepreneurs have a good idea, right? But they want to protect this idea. They want to protect, per se, the cap table. They want to protect, per se, their equity. But in the deal, and they want to protect probably further around dilutions, right? Along their journey. But they really need to ask their ego again. Um, Today, what is being offered, is it, straight up investment, equity exchange, etc., or is it financing and I retain equity for further rounds, etc., or are we doing some equity based, performance based contingency kind of arrangement based on succession there. um, so there are different, I guess, game plays on how they're wanting to do it, and they have a mindset here that, oh, this is my little baby Joe here, my project. But the little baby Joe project, has became a little baby, but now is probably went to kindergarten, grade school, college.
Now it's a
But you have to
teenager.
figure out.
Now it's a
Say
teen.
what?
Now it's a teenager.
Yeah, now it's a little mature, they have some sales boosting. So now they got to decide, where to continue, what's the next game plan. And if that next game plan is putting their ego aside and rehashing, their protected covenants going into the deal, because some of them come in so, square minded into their comfort zone, but asking for 30%, 10%, whatever equity exchange, blah, 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 or some board of director per se exchange, etc. But if they would rehash there and say, hey, leave the door open, and some founders do leave the door open, but others don't, right, Jack? So I
Yeah.
would say if they leave the door open along the journey and don't burn all the bridges, because you never know who's in front of you that can help you, get to the next step, along
Can
the
you
journey.
can you give an example of where ego, can enhance or blow up both fundraising and an exit? Because ego, king in the kingdom or queen in the queendom, in companies, can be a positive thing or a negative thing. So, maybe you can talk a little bit how ego can affect fundraising and how ego can affect exiting.
Right, right. I think it, ego. I mean, will either make you or break you. I mean, it can be detected in the door, your ability to listen effectively, communicate effectively, and take on the cadence of the investors on the VC. One time I had some of these young VCs pitch me, and they just started pitching, and I was like, I didn't say start, I was going to say, hey, let's program for another time. So I had to, unfortunately, cut it short there because he just went on, and I
Yeah.
think, you got to realize the turfs in which you walk. And for example, basic business etiquette, when you go to an office there, you don't sit down, you wait to be seated, right? Um, so I think, if you can sharpen, along with the ego, be conscious of emotional intelligence, factor there, your culture factor there. I remember one time we were doing a deal in, for example, the Middle East, and they have a specific way of talking, right? In
Yeah.
doing business, right? Before you talk business, you got to go over some other things, right? But so be culturally, conscious of different cultures of the world and different people, and I guess their per se tolerance, right?
Yeah. Let's flip the script a minute. What
Okay.
about ego? What about ego on the part of investors, and how that plays a role in fundraising and exit with entrepreneurs? Because they're two-sided
Yeah.
equation. There's two players here. Both with hopefully similar objectives, but sometimes you get into a situation where you have either an entrepreneur or an investor whose ego gets in the way of getting to the fundraising deal. Maybe you can
Well,
comment on.
I think that's the taste of the waters
Yeah.
of collaborations. Everybody's has different personalities. Your ability to read the personalities, kind of like when to hold them, know when to fold them, and walk away and run, kind of thing. Kenny Rogers.
Yeah.
Um,
Yeah.
so
Exactly.
you got to be a mastermind of reading people. I remember in the emergency room, um, whenever the patient walked in, my teachers there, they said, you need to read the patient when he walks in because it's telling you something. You
You
need to
know,
read the person, right?
yeah, it's interesting because a lot of times the mindset or the common thought is that you have an investor and an entrepreneur, and the investor's holding all the cards because they have the money. Well, sometimes there's an opportunity so good out there that a lot of investors are looking at it and they're competing, to have a role or a part in this opportunity. And at some point, the afflictions that affect the CEO of the
Mm-hmm.
entrepreneur side can sometime affect the investors, and that gets in the way. And at some point, some entrepreneurs need to know when to walk away, when to
Right,
or when to
right.
call time out, and put either reset or walk away. And
Right,
maybe
right.
you can talk about that a little bit for our investors.
Yeah, yeah. For example, in the investor's mindset there, you got to be careful if you're dealing with the greedy VC. If you're just another deal, you got to understand there from the get-go, uh, the coachability relationship between the founder entrepreneur and the VC firm. Will it exist? Will it not exist? Some things they have different personalities to push you out a run and kind of let waters taste be tested. And in that sense, you got to realize, what is your expectation, regardless of the sense. They're going to push you out there and say, hey, you need to have your sales hat on and your marketing hat on. And who holds that? Well, the founder, the CEO initially. You better master it. You better start to negotiate equity or some kind of percentage exchange to
Yeah,
be feasible. And you got to watch your burn rate going along the way, right?
yeah,
Because you might get in a hole that you can't get out of, right?
It's a two-way street, and a lot of people don't recognize that. Entrepreneurs sometimes feel that they're in a subservient role because they're asking for money. You know,
Mhm.
a lot of, and this is for the benefit of our entrepreneurs. Now, entrepreneurs have great potential to create value and create
Mhm.
really good returns for investors, and they need to recognize that when they're out there looking at the investor side, they have to approach that with the same amount of due diligence as
Mhm.
as an investor approaches an entrepreneur, because nobody wants to have an unfair or a non-workable agreement in a situation that could work really well. And so everybody needs to be cognizant of these things that are going on. You,
Right,
you
right.
talked a little about coachability.
Mhm.
Talk a little bit about the need for entrepreneurs to have an open mind about following some suggestions from investors, because investors that do this for a living, whether they're angel investors or full-blown venture capitalist funds,
Right, right.
these guys have a business model. Some of them are cold business models. Some of them are more humane in the way they approach
Mhm.
the entrepreneurs. But talk a little bit about some of these things that go on between the entrepreneurs and the investors from a coaching standpoint. And I'm talking really now to the entrepreneurs about being receptive to coaching.
Right, exactly. Sometimes you're going to go in there with your plan A, the pitch deck, or the elevator pitch, and you might get some feedback. You have to be very key and receptive to taking feedback, and that will determine your coachability. Sometimes, I've seen it done in different ways. Sometimes the VC player will say, "Hey, don't like this, don't like that," and no, but then you're going to be on your plan A, B, and Y. You better not ruin the relationship there on your plan A, B, C. You better be able to adapt and adjust to plan Z on the spot, Zeta on the spot, right? So I've I've seen that happen a lot. I mean, I've seen some of them sometimes where they're swearing up and down, right? And then the other side swearing up
Seen
and
that.
down,
We've
and
all
then
seen
and
that.
then and then and then that's your test of ego. I've seen people, you know, act like little kids, from the entrepreneur sense, but they don't have the cards in that play. You got to be mature there, adjust, and take feedback and continue.
Oh, you got a little freeze
And
there. There you go. There you go. You froze for a moment. Are you
I
still with
can
me?
you hear me?
There you go. Yeah, you froze for a
Yeah, I'm
moment.
still with you.
Okay.
I'm still
Eh,
with you. You think maybe I should turn off the camera to help there with
No,
that?
I think we're okay for now.
All
I
right.
think I
Okay.
think we're good.
You let
All
me
right.
know.
Well, that's great. So let's switch gears for a little bit. One of the things you mentioned earlier, and I think we just touched upon it the other day when we spoke, was cap tables, dilution, and equity retention, which
Mhm.
are all things on the mind of entrepreneurs as they take their baby. And this is something that
Mhm.
is really, really important. And it's sometimes hard because when somebody creates something, it's their baby. It's like a child. They bring it up and
Sure, sure.
they nurture it, and there's a lot of emotional attachment to it. And one of the things that entrepreneurs struggle with and probably need to learn is how to how to look at this objectively rather than subjectively. It's really hard, and it takes a lot of discipline. But let's talk a little bit. Maybe you can identify some of the biggest mistakes founders make when they
Right,
talk
right.
about equity and cap
I
tables.
Yeah, I think I have some good examples here. For example,
Yeah.
some founders in Pacific, they're going on to, I mean, the pre-seed and going to Series A. I mean, you need to be an equity god essentially, right? In that aspect, you need to learn how to control the equity along your journey, and you should be going, at least with retaining 80% of equity and seeing what you can do with the other 20%, right? We do also do some equity based performance deals, right? With certain collaborators, right? But if you don't retain that, so to speak, position, you're going to be prepared to be upside down along the journey.
Quickly,
right?
yeah, quickly.
Another example is for example, we can get them financing, right? Maybe it's a little bit riskier, but they maintain more equity going along the way, right? There's different conditions, obviously. It's not set in stone. There's different players there. But
yeah.
I mean, another thing in terms of financing, I had one example. The guy just said no to it, but I mean, I said, well, you need to think if you want to be an entrepreneur or not, right? Because this is the difference of starting today as opposed to tomorrow or never. But
when you talk about financing, I think you're talking about debt financing as opposed to equity financing. And,
exactly.
And the thing is that entrepreneurs have a mindset, and so do investors to a great deal, at least from our experience. And again, when I quote something or when I talk about a trend, it's just it's through the blinders that we operate in, and there's always exceptions to to the way we might view the world. But when we talk to early stage companies and investors who invest in early stage companies, debt is something that a lot of people like to avoid because you don't want to see debt on the balance sheet. Investors don't want to be investing and paying in servicing debt. They want to be investing in growing and scaling a business, right? So they can get better ROI. When you get to a business that has a run rate and the ability to generate predictable revenue, you can think about debt financing because you can service that debt comfortably and not give up equity. And that's one of the ways you can retain ownership and not get caught up in this dilution versus long-term value with with an entrepreneur.
Right.
Okay, so maybe you can think about how should investors think about diluting their position versus long-term equity? Because when you look at a company that's going to go, it's it will do an exit, it will have a liquidity, and there will be a multiple. Sometimes, maybe you can comment on how they might look at that in terms of not letting something slip past them.
Yeah, I think that's a good point there, Jack. That's basically what we look in, the private equity, right? That's our game plan. Find business plans that we can, buy, build, grow, investor operator mindset, and figure out if it's a multiple or not. Pharmaceutical industry, biotechs, they have great multiples like to the ceiling, right? Certain tech deals. So and those are going to give just because there's not another competition cure to cancer or they're patent protected, right? So that's kind of like market exclusivity, right? In a nutshell. In some of these clever tech kind of startups, it's saturated or they're competing all against one another in a sense, right? Those are other strategies. But one of the other things is that some point or another along your journey, I mean, shares will be issued and you'll be diluted. Think of how I believe Bill Gates ended up at the end. He ended up with 1% of Microsoft or fractions of a percent, right?
Still a billionaire, many times over, right?
Right, but so is their portfolio company.
Right. So that's the thing. That's the short-sightedness sometimes I think we see among entrepreneurs, because there's this perception I gotta retain 51% I gotta retain control of the company. I gotta do this. I have to do that. I can't let the investors get control of my baby here. And the thing is, at the end of the day, you build a company to service a need, solve a problem in the marketplace, but you also build a company to make profits and grow your interest in your equity and your wealth. I mean, those are equally valuable objectives as much as building a product or a service that solves a real problem in society. And so
Right.
sometimes entrepreneurs lose sight of that.
Well, one of the common things is, solve a huge problem in society, but then, the entrepreneur there, he has his own ego to solve. So he
Yeah.
can't solve, the problem to society without solving his psychological ego and problem. But in essence here, that, the thing here is that, faster you that's where the coachability comes, because investors, I mean, or even if they're offering you finance, because investors have the capital to finance the deal. And so you got to be very, you got to notice this. You want to go in there with your protective covenants, this, that, whatever percentage per this round. Oh, right, who cares? So the thing here is that essentially you're being faced with, you got to decide when to let the baby go, and is it worth it. The average typical CEO is 3 to 5 years lifespan, on an average of 3 years. So you're going to get replaced at some point. And it's just the nature of change management along the journey, right?
Yeah. That's a key thing, is change management. A lot of CEOs need to work at understanding what effective change management looks like. The thing is that every company, as they grow, and I've worked for companies that started out as companies in a barn and have gone on to be multi-million-dollar companies. The mindset of the company and its objectives change over time. The things you do as $1 million company are very different from the things you do and need to do as a 5 million, and then a 10 million, then a 20, 50, $100 million company. Things change and mindsets need to change. There's
CEO.
Go ahead.
Yeah, the CEOs, I think you're hitting there. The CEOs got to realize that regardless of it all, they're going to be dancing to the music of investors or the board of directors or their
stockholders.
public, their shareholders, right? So you got to learn fast to be coachability, let it go, and begin to dance to the music to them. I mean, the faster you start dancing to the musics of the other egos, then the better everything's going to go for you, because basically you're just a puppet on a string, right? Representing this mission idea, which was your crazy idea in the first place, right?
Well, it's
Because
not just
you came into the VC, telling us, how great the project is, how good you are, and how great you're going to be afterwards, But so let's see how great you're going to be once the music starts playing, right?
it's not as much as it is how fast you dance. It also is how well you dance.
Right.
You have to juggle. As a CEO, you're juggling all kinds of constituencies and often competing objectives, and competing concerns. And so not only do you have to dance fast, you have to dance well.
And also you got to learn how to listen to others' music, have some tolerance there. Because
you can't just do the polka. Sometimes you got to do the square, right?
Right, or the mariachi dance or something, right?
Dance.
Whatever culture it is, you better pick it up fast, right?
I watched this movie, Wall Street, and both of them. They were Michael Douglas movies. They were actually pretty good movies. But there was a line in one of the movies that stands out, and the line is when Gordon Gekko, the main character, is talking at a shareholder meeting, and he's talking about taking over a company that's dying, and the executives are just trading paper and perks and whatnot. And he comes out with a line that says, "Greed is good," and
Right.
maybe you can comment on that on that aspect of starting a business and running a business, about the concept of greed, because greed has many definitions, and maybe you can comment on that.
Well, I mean, that's a good one. That's one of my favorite quotes. But I think there's two sides there. There's a VC, mindset. They think greed is good. If you imagine you have a fund there, they're gonna be leveraging the fund with debt just so you can leverage, your pool investments, right?
Yeah.
So I mean, either you're going to accept debt from the VC tag along and get your equity, lopsided early, or you can see if you're healthy enough to do some financing. And then you have the entrepreneur kind of mindset there, that he is, like I said, he has the best ideation. The idea is great. He's going to be great. After the deal's done, he's going to be great. His wife's great. His kid's great. The church that he goes to is great. But, that doesn't matter. What really matters is show me your performance, right? Show me your revenue increasing over these quarters, your EBITDA, the whole bottom line here. Let's see what you're doing in, sales, right? For some reason or another, sales and marketing, you cannot escape from on these financial statements, right? And your performance speaks, right?
That's
but greed,
it's a key
in terms
skill, a key skill.
Right. In terms of greed is good. I think, it's the necessity that, drives the entrepreneur and the American economy and the world economy. And I think, there's a reward side of that. And, you guys, understand it as entrepreneurs standpoint. I think you should, but also, at some point you will be rewarded, but also, go off of your backbone there, your why, why you're doing this. Look yourself in the mirror and say, do I have enough integrity along this journey, right? Because with integrity, you get longevity, right? So
hopefully, right? Yeah.
Unless your greed is very lopsided, right?
Well, there's a difference between greed and gluttony, right? Because you can be greedy in the sense that you're driven to complete a project, to get a concept from a napkin and a coffee shop into a factory, or into a design center, or some thing that produces a good or service. That kind of greed is good kind of greed. Then there's gluttony, where people just cut short. They take shortcuts, and they're looking just to make a profit, without considering the quality and maybe some of the consequences of not doing things according to a plan, according to quality standards or procedures or accepted norms and whatnot. So you have to really be careful about greed. It's
right. There's a quality side of greed, right? And
yeah, there is. So greed can be good. Let's put it that way, right?
Right.
Okay, all right. So let's switch gears one more time. At the end of the day, I'm an entrepreneur. You're an investor, and I want to access critical capital to make my project go. I can't do it without capital. And as the investor, I want to acquire an opportunity, or work with an opportunity that is going to allow me to put some money in and get some significant rate of return out of that money in some well-defined period of time. So we both have objectives, and those objectives, in a perfect world, are non-competing. They're actually symbiotic. And that's the best of all worlds. But let's talk about getting a deal done. I mean, that's the whole idea of why we do what we do here, right? We're we're trying to get deals done, and we don't want to get a deal done just for the sake of doing a deal, because a bad deal, is worse than no deal, unless a bad deal
Right,
can be
right,
justified, right? So let's talk
right.
about that. All right, let's
Well,
talk
yeah,
about.
I think that's very good. I believe that a deal is better than no deal, because and you got to be conscious of that along your journey. Um, and and so if you think about it, hey, whatever I'm doing here, if I can look myself in the mirror, and if it makes money, makes sense, and we just go on, and it's progress, and it'll result in an exit if I dance to the music of the investors, etc. All probably not the best deal, but it's a deal, and it progresses to your track there as a CEO, or the next thing, the comfortability of doing more deals, right? Some deals you win, some you don't. Some there's you know the ones that win are the ones that lose, and the ones that lose win from the superficial standpoint, right? So there's multifactorial analysis there on the aspect of a deal, right?
So here's the here's the this is a paradox, I guess. You know,
Mhm.
this concept of a bad deal is better than no deal does not conflict with the idea that any deal is a good deal. And the reason why I say that is that when you're an entrepreneur or you're an
Mhm.
investor and you've connected with somebody and you've invested time from the uh, from the creativity side of the good or service you're bringing to market, and you've invested money, which are assets, from the investor side. At the end of the day, that's time, energy, and money and resources that
Mhm.
both people have put into a project. Now, that project, you know, may be a unicorn. It may produce, multiple rates of
Mhm.
return, and it might just be an also ran, right? It'll produce something, but not quite as dramatic. And the idea that you create a project, you get funding, and you don't walk away with anything, that's not a really good feeling for anybody. So to your point,
Mhm.
any deal is a good deal, will allow both parties hopefully to recoup some of the effort, some of the time, some of the resources, some of the sweat,
Mhm.
some of the emotional investment they've both made, as well as the capital investment, you know, into a deal. So there's a lot to what you say that's true. That any deal is a good deal. Because it
Mhm.
doesn't conflict with the idea that a bad deal, no deal is better than a bad deal. Because if you do no deal, then everything is wasted. Everything is wasted.
Sure, sure,
So
sure, sure.
I see your point. 100%.
Well, if it makes money, it makes sense, in the sense that
Yeah,
we're also looking for good business, right?
for sure. Yeah.
And that's where, the origins of proof of concept comes in. Um, and sure, going out of these, where the majority of these are, they have to be the experts of the sales team, or the 1,000-man sales team. Sometimes we say, hey, Mr. CEO, you need to pick up the phone 200 calls, or do whatever you need to do a day to get some results. You need to be the sugar daddy. You want this or not,
You're 100% right. I don't know if you remember. You may not be old enough, Joe. I don't know how old you are, but when
Okay.
I when I was younger, there was a commercial that United Airlines ran, and
Hmm.
it was about a company that began to lose clients and customers and sales. And the
Hmm.
CEO is sitting around talking to his managers, and he can't figure out what's going on. So, it cuts away to him talking to a travel agency and having a handful of airline tickets. And the
Hmm.
CEO is going, "We're going out and we're going to go visit our clients." And American,
Hmm.
the American Airlines ad was, United Airlines is going to take you there, right?
Right.
That's going to be a travel partner. But the message, though, the message was that you've made before, is that you got to get out in front of the market and the people that you're serving. And if you can't articulate what value you have, both to the market you're talking to and to the investors you're working with, why are you in business? What are you doing there?
Sure.
You know,
Maybe they're missionaries, So some think tanks over there, some
where,
nonprofits.
where do you see deals fall? What's the main cause that deals fall apart from your perspective?
Mm, it could be multifactorial. I mean, it could be
Top two or
competition
three.
is,
Yeah, top two or
you
three
know,
reasons, maybe.
maybe it's not time for a substitution in technology.
Okay, timing.
I've seen some AI things that, well, yeah, it's AI, but can't you do the same with ChatGPT or OpenAI or like anything similar, Copilot? I mean, like, is that really even innovation, right? Um, so you got to really ask yourself that, timing. Some time to and a gap in the solution, others don't. And then, but then again, like, where's the proof of concept? Like, when you ask the entrepreneur how long you've been working, and there's a bunch of years, so then you get into deep black hole ideation, or research rats at the university that they just go in circles, right? But another thing is, I would say, probably they can't convince others to invest, like, or they don't invest themselves. So then either, that's indication that your idea is
They don't,
lunatic, right?
they don't walk. They don't walk the walk. They talk the talk, but they don't walk the walk. Is what you're saying, I think.
Right. And then another one is that, they want to be Mr. CEO and all that, but like they're embarrassed to pick up the phone and dial. I mean, you gotta. I mean, it's tough. You need to deal with, sales team over here, and then also trying to find investors over here, and you got to be mentally strong. I think some of them, I think as you go through there, if you can be mentally strong, but if you're mentally weak to the no, and you're weak to asking, and you're weak to negotiating and adapting, you're going to cut yourself short. You need to realize on the other end, what's the maximum value that others can give you, and how you can, negotiate those terms of collaborations, right? I think I would put number 4 there on how they can think of success on their journey. I would say you got to think always to play the win-win. It's in Spanish, ganar. You have to figure out the win-win in the situation, and whenever you figure out the win-win, I think your whole life will change. Some people aren't used to playing win-win, but the faster you figure out how to play win-win, a lot easier the journey and the road will be, right?
I want to go back to your comment about picking up the phone and talking. It goes right back to the very first thing you talked about. I think is about understanding why you do something. Because if you understand why you do something in your mind, you can easily form, the value of what you're doing and why what you're doing is important. And if you understand that and you can accept that and you feel confident in your why being a valid why, it shouldn't be too hard to pick up the phone and make
Mhm.
those calls when those calls need to be made, because you have a commitment to the why. You feel confident in the why, and confidence. Confidence is as important as competence. The two are
Sure.
hand in hand. You have to have a skill set, but you also need to be confident in your skill set. And if you understand your why and you believe in your why, picking up that phone to make those phone calls, whether they're to investors or customers or suppliers or other stakeholders or employees, it doesn't matter. If you understand why you're doing something and you believe in why you're doing something, the confidence should be there to do any and all of that. And that's a skill that CEOs can learn. They can learn that skill. They can. And
You
it
know,
goes
it's the fastest way for them to do it. Just be proactive. They can start today.
yeah. Pick two or three things. So we're coming toward the end of our time. I wanted to just maybe kind of get your sense of, given where things are in our economy right now, and some of the flux that we're seeing, and the political situation in our country. What's your prognosis for the investment community, for the next, let's say, 6 to 12 months?
All right. I know mindsets have switched. I think right now we're seeing, renewable energy. Millions, billions of dollars have been spent on that, not making a difference. I think we're seeing, back into the oil and gas industry. I think that America has a mission there to become sustainable, right? And sufficient. And I know that they have adopted that from other countries, but I know if they balance their energy side out, things will change. Whoever controls energy controls the world. Right now, I see AI is booming like crazy. There's great horizons on that. Creating
That's an interesting concept, because a lot of the things that drive economies are intertwined.
right.
Nothing moves. Nothing gets powered. Nobody can move from A to B. Nobody can heat their house, light their house, run their computers without energy. People can't drive their car, right? So, oil and gas kind of drive all of that. And then aside from that now, because especially in our country, we've moved more to a service information economy. Now, zeros and ones are important. Digital information. And, you can't have digital information do anything without it being powered by something. Right? So without either oil and gas, electricity, solar, wind power, or whatever it is, bacteria, making electricity in some cases, the zeros and ones are useless, because they can't thrive without electricity, right?
Right. I think we're going to see, nuclear investments.
That's an interesting thought. That's an interesting thought. That's what we've seen. We've seen a couple of projects over the years where entrepreneurs are talking about making these very, very small, localized nuclear reactors that can power, local geographies. And that may be something to consider. There's always a safety factor involved with nuclear energy, but I think the human mind can and is capable of creating pretty safe, pretty good safeguards for nuclear energy. But, that's a whole separate show and a whole separate conversation, I think, right? But,
right.
Well, all right. So I want to respect everybody's time. Any last comments for us, Joe, before we close up today?
Well, I say, to all entrepreneurs, if you're ever stuck there, wake up every day, ask your why, look yourself in the mirror, and, ask yourself, what can you do today to be most proactive? What every day you can add something to your journey or mission. Being proactive is just an investment to your journey to be successful, right? And also be conscious there of, being coachable, and be open to mindsets and adapting to others along the journey, because it'll be the difference of making it work and not. Leave egos aside, be the leader there to coach your team or to confront the situation as professional as possible, right?
Yeah, exactly right.
And live another day, and keep going, and get through this one. Understand your time is short as a CEO, and you got to move. And if it's a matter of moving make that difference for you and the project and the why of the people, I think, I think you're on the right track, sir.
Good. Joe, I appreciate your time. Your insights are valuable, and we greatly appreciate you coming on today. I know that this may have been the first time. I think you did a really great job of commenting and addressing, some of the topics that we talked about. So I want to thank you for taking time out of your busy day. I know your time is valuable. I have to thank again Alejandra and her team. Alejandra, great job. We always look forward to the work that you do and get us prepared each month. So thank you so much. And to folks who may be listening in or who may get a copy and watch, feel free to reach out if you have any questions. We always appreciate talking and getting comments and feedback from the folks that we interact with day to day. So we'll all see you again next month. It's next month is Thanksgiving, so we'll have an interesting conversation. We'll figure out another guest next month. And again, thanks so much for your time, Joe. I hope to talk to you again. If you'd like, you're welcome to come back on the show.
Hey, thanks, Jack. I'm just warming up. But we'll be back for more swinging. This one was to get the butterflies out, but
you've got let's put it to it. You got a future. You got a future in this game. There you go.
Hey, thank you for the feedback.
All right, take care, guys. Be well. Stay out of trouble.
Right, see ya. Bye bye.
Bye bye. Thanks.